investors and traders, and welcome to the weekly market report with Market Guys. I'm AJ Monty. I'm starting off this week with a chart of the volatility index, ticker symbol VIX, because I think out of all the charts that we're going to look at here now, this one is one of the most important. And the reason for that is if you look back in history at the price action of the VIX, you'll see that we have a pattern that's pretty easy to follow. Look at from this high to this low. Keep an eye on this. Now watch, from this high to this low. Now watch, follow me. From this high to this low. From this high to this low. And now, recently, this week, from this high to this low. Look at the angle of these down legs here, and you'll see that, number one, they're short-lived. The move from the high to the low, very rapid decline in the price of the VIX, very short-lived, as I said, and the steepness of that angle is very important because the angle of this sell-off in price many times determines the angle of the bounce. Again, follow the bounce now, from this low to this high, from this low to this high, from this low to this high. I don't want to confuse you here, but what am I expecting? I'm expecting another bounce, just like what we've seen in the past, maybe even as severe in the angle, but I'm going to be conservative and put it out right about there. Now let me erase these lines, and I'm going to draw a couple more. Zooming in, you'll see that the lows are matching up perfectly. The low here, this support level from May 22nd, matches up perfectly with our low today. There are gaps above the market. Again, if you're following along with the market guys, 80% of the gaps that I track, and I'm being conservative again, 80% of the gaps fill, meaning prices go back up to where they gapped in the first place. For the VIX, because it's an oscillating indicator, 100% of the gaps prior to this date, right here, that's on July 10th, 100% of the gaps prior to that have filled. So that could even increase the probability of the gap filling. So I'm going to, again, draw that line to the gap fill point right there. Now, for investors, yes, this is important. For traders, it's even more important because a bullish VIX means bearish S&P conditions. So let me jump right to the S&P. This is the S&P 500 Index ETF. This is the spiders. And you can see almost the opposite has occurred. We are at a resistance high. In fact, we're at a lower high than the previous highs. And we have gaps here and here on the S&P. So I'm going to be conservative and draw my down leg down here. That is a bearish chart for the S&P. Whenever you have angles that are so steep like this on dropping volume, that tells us that the buyers are losing momentum. So between the VIX being a leading indicator and volume also being one of the forgotten leading indicators, we have bearish conditions all over the board. I can go to the Dow and show you the same thing happening there through the diamonds. That's the ETF, ticker symbol DIA. Same thing. We have lower highs now forming, gaps below the market. My projection for the Dow is again a conservative gap fill here. Same thing, Qs. Let's look at that. Let's look at the tech sector. Look at QQQ. This is the power shares. And as I zoom in here, you'll see one of the steepest inclines in price or short-term upward legs that we've had in a really long time. In fact, it doesn't get this steep if you look back in history. Even from this low to this high was not the same angle. This angle right here is a very steep vertical angle. Therefore, I believe that the Qs are going to pull back here, and that I'm going to leave that line up there for next week. So finally, the only thing that we have left to look at in our weekly market report is the Russell 2000. That's ticker symbol RUT. And we can see that we have lower highs forming. I'm not going to go so far as to say that this is a head and shoulders top, although some may argue it is. But these are the key trend lines that we have to look at. We have to look at connecting some of these lows and even projecting here. This is a key support level for the Russell 2000. And I do think that we're going to come back down to at least test that, fill the gaps, and then move on from there. We'll have to reevaluate the market once we get to this support level right here. Now, if you've been following along with the market, guys, you know that this coming Monday we have an open house Q&A session. It's free to the public. On our website, www.themarketguys.com, you'll see that on our Twitter page right down here. You will be able to register for free, save yourself a seat. Now, seating is limited. We do cut it off at 1,000 people, so we're pretty close to that now because we're so close to the actual start date. But you should go in there, reserve a seat, and then follow along. I will analyze your stocks, I'll answer your questions, and give you some good ideas moving forward on what we're looking at as a community of investors and traders. At the Options Oracle is Twitter, and then you can go to themarketguys.com to click on our website. We're easy to find. We have a lot of educational material there. We have the video link. It's a library of very short videos that talk about all the things that I mention in my posts. And this, again, is all free. 3 to 4 minute videos. I think the longest one is a 7-minute video. You can almost hold your breath here and watch these videos. They're that short. And you can take this as your daily financial vitamin, if you will, each and every day. So that's my market report for this week. Have a great weekend. We'll speak with you on Monday. So long.